Hey everyone, it's Alissa Coram here. Now, as traders, we don't have a crystal ball, but we can look at history to determine probabilities of what could happen in the future. And Mark Minervini, founder of Minervini Private Access, recently joined IBD Live to discuss some cycle work he's looking at to determine what could happen in the stock market in the next 12 to 18 months, given the presidential election cycle, seasonality, and where we are with interest rates. Take a look.
If you look at cycle work, and I don't trade on cycle work or if you get into seasonality and things like that, but I'm always aware of it, especially when there's a very strong tendency. And then I look for the conditions to back into that period. So we have some really strong cycle work and tendencies based on the sorry about that, based on cycles and based on the presidential cycle. If you take a look at the four-year presidential cycle, we had a very strong tendency going into the second half of 2024 and the first half of 2025, which is a 12-month period. And when you look at this cycle work, you don't look at the actual direction as much as the trend, or you don't look at the wiggles. You look at the trend, and this is a really strong, persistent trend. Now, what we have a potential of is rates coming down. Of course, I think the market was a little too aggressive with their anticipation of a rate cut in March, and now that's starting to come down because those probabilities were way up like 80, 90%. Now they've come down to like 50%. But we could be getting rate cuts that will fall sort of into this same period. And when you look at the first rate cut, now this is looking at a rate cut without a recession. That's where the real power comes in. With a recession, rate cuts are still bullish. And if we got a rate cut, even with defending the economy, there was a recession, that could be bullish. It would probably be delayed though. And that could, of course, get us into that second half. But that second half is coinciding with potential rate cuts. And after the first rate cut from a non-recessionary period, look at the tendency. Very, very strong tendency. So if we get those, if those rate cuts start coming in around schedule where we're pricing in here, which is over the next several months, 6 months or so, and that's where the rate cycle starts turning down, you couple that with this strong seasonal tendency, not only can you have a very explosive period for the market overall, but most likely this is where money will rotate out of the areas that have gotten themselves extended and overowned and go into the small cap. The Russell 2000 has underperformed since the lows of October. S&P's up about 35%. Russell's flat. Also, the mid cap, you look at the S&P 400 mid cap, look at this big base that has been formed. This is setting the stage for a nice rally, and I think that that's what can fuel it, and it's coming sometime this year, mid-year, going into the mid part of this year, into the next year, and this could be a really explosive, very, very profitable time for investors like us who buy breakouts and look for those higher octane names. Even the IBD 50 is starting to turn up and starting to turn into an uptrend, so I think that would also be good for the IB 50 type of names.
Yeah, Mark, a very bullish roadmap you're laying out for us. So if we do get alignment on those conditions by about mid-year, how are you handling your positions in the meantime? It sounds like going with the leaders, mega cap tech, selling into strength, and in the next couple of months, looking for new setups and that potential rotation to develop.
I'm still looking for setups, and we're still finding them. We're still seeing stocks coming out of bases here and setting up. There's a lot of stocks and bases, and that's the first thing. And what we need to look for, number one, stocks and bases, tightening in price on the right side, and then breakouts, and then how well those are holding up if we're getting follow through, and that rotation, that participation. Right now, we're getting the same scenario that we've seen many times where the market moves to new highs or breaks out, and then the participation, we get a divergence from the participation looking at either the percentage of stocks above the 50-day or the percentage of stocks above the 200-day. Right now, there's about 40, I think 47 or 48% of stocks above their 200-day moving average on the NASDAQ. That's a pretty big divergence, and that usually leads to a pullback. So you don't have a lot of participation. Still, all the money's going into those mega caps, into the top tier, top market cap of the S&P 500, still about 45% of the the market is in the market cap is in like 20 names, 25 names. 25% is in 5 names. 5 names account for 25% of the entire market cap of the S&P 500, which is astonishing. So at some point, we're definitely going to get a rotation, but we need the rate environment to change, and the inflationary environment obviously is what pushes on that. Um, so we're doing the same thing here and having great success. We've had a really great period this last few months, and coming off the lows here have been a fantastic period. For trading stocks. It's just that it's been a narrow rally.
Yeah, I know. Mark Ritchie on your team, when he was with us a couple weeks ago, I loved how he put it. He called stocks like Microsoft the "if you can't beat them, join them" trade. So I
That's
feel like that makes a
That's
lot of
exactly
sense.
what we've done. If you can't beat them, join them. So we threw in the towel, bought Nvidia, bought Meta, bought some of the mega caps. We bought Google. We pared down going into these earnings and sold the majority of the position. Held a little position, but Google's still holding our stop here. So on that little back end piece, we're still with Google right now. And yeah, so yeah, the if you can't beat them, join them trade. That's what we're sticking with for now, and letting the market dictate. And again, as much as we look at this, we make forecast, we're not going to trade until we actually see it presenting itself in the market. I can start buying small caps and buying the Russell 2000 just because we think it's going to go up. But look underneath the hood, look for the individual stocks. When they start coming out of bases, you'll see that proliferation. And when those names start to proliferate and start to emerge, then you start shifting into that area.
And Mark, you have so much experience and many different market conditions you've traded in. So again, going back to this potential alignment down the road mid-year, how aggressive then are you going to be, and how is that going to show up in terms of the setups you're buying, your position sizing, and how long you're going to try to hold stocks for big moves?
Right. So I'm a swing trader, so I hold for days to weeks to sometimes months. I don't generally hold more than a couple quarters. I might get through one or two earnings reports, but that's usually sort of the meat of the move. Even someone like Kenny Hebner back in the day who ran the CMG fund, his whole time was 2 or 3 quarters generally. So similar to that. As far as level of aggression, as far as aggressive trading and position sizing, if trades are working, I'm going to get very aggressive, and my position sizing is going to be big. That's the way you make the big returns. Is at some point you've got to take some positions. If you're all over the place and you own 20, 25 names, you're going to get a smoothing effect. You're basically a mutual fund, and you're going to track the market. Now that's also a good way to detect if you're really producing alpha and you're in the names that aren't maybe market names. And if you're buying all the names that are the high market cap names, you're going to go up when the Dow goes up, down when the Dow goes down, and you're basically going to track the market. You're not going to outperform very much. So we're looking for alpha areas that are zigging when the market's zagging, and zagging when the market's zigging, and that's where historically the small and mid caps have been where I've made a lot of my money, but that just hasn't been the place to be for quite a while now. So we're putting the money wherever money is being put to work.
So in percentage terms, define big for us. What is a big position size to you?
Well, yeah. So big is really personal. It really comes down to what your risk tolerance is. So if I'm taking a particular position size, it doesn't mean you should. You really have to position size we call it the pillow factor. Sell down to the sleeping point. We've heard people say we call it the pillow factor. You got to be able to sleep at night. And that means that if you're getting jumpy and maybe selling your stock before it hits the stop, or selling it and not allowing it to the gains to come to fruition, usually it's because you're trading too large, and it's just too big for your risk tolerance or your experience level. So for me, I mean, go back to the U.S. Investing Championship, I was 4x leverage. That because everybody else was, as you heard me say many times. If you're playing in the NFL and the lineman on the other side, on the other team's taking steroids, you have to take them too. So to get that big return, I needed to really lever up, but at very, very opportune times, not out of the whole year, I am very seldom ever even fully invested. Every now and then I'll get real heavy. So there's a couple ways too. One way is to have overall exposure. So I might have, a number of names that gets me the overall exposure, but my individual position sizes are maybe 5, 10, 15%. The other way is have very large position sizes. And now maybe I'm not even fully invested, but I have 25% positions and I have very concentrated positions. So it's one or the other, or a combination. But what I try to do is work up to from the smaller positions as I start getting traction and I earn the right to play larger. But by getting some profits with the smaller positions, then I work up, and I want to work up to 25, 30% position sizes in my bigger names, my best performing names.
Right. And using proper add-on entries to do so, not just percent gain targets when you're doing that.
Exactly.
Yeah. Great. Okay, Mark, anything else on the macro side that we should be thinking about here as the setup for what you're looking for to play out over the next 6 to 12 months?
No, volatility has been really low. The VIX has been, and this is exactly what we wanted to see when we started turning bullish on the market uh, uh, back last year in the beginning of the year. It was because volatility broke down. You can see you had high volatility during the bear market, and then when you broke to those lows, that's where the market has turned up and into an uptrend, is acting well. So that low volatility is really good. The only problem is that from the low volatility, for extended periods of low volatility, it leads to some high volatility. We're going into earnings season right now. And that usually there's volatility around that. And with volatility being so low and a lot of stocks extended, you're probably looking at a pickup in volatility and some pullback. So I'm expecting that, using strength for selling, and then taking that cash and waiting for the next setups.
Now, I really hope you enjoyed this clip, and be sure to tell me in the comments, what are your expectations for the next 12 to 18 months in the stock market? Is that something you're looking at? What factors are playing into your outlook, and how are you planning on handling your portfolio given your expectations? Let me know in the comments, and be sure to subscribe to my channel so you can stay up to date on all the latest videos, and I'll see you next time.